Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Solvency Ratios Explained, a simple guide to assessing financial health. Interpreting solvency ratios. Understanding solvency ratios is crucial for assessing a company's long-term financial health. These metrics help you determine whether a business can sustain operations while meeting its debt obligations. But how do you know what's good, bad, or alarming? Let's break it down. What is a healthy solvency ratio? Not all industries are created equal, and the same goes for their solvency benchmarks. A healthy solvency ratio depends on the industry norms, company size, and business model. Here's what you need to know. Debt-to-equity ratio. A ratio below 1 is generally considered solid, as it shows the business isn't overly reliant on debt. For capital-intensive industries like utilities or manufacturing, slightly higher ratios may be acceptable, since these businesses often carry more debt to fund assets. In contrast, businesses in tech and services, which rely less on physical assets, should aim for much lower debt levels. Equity ratio. A higher equity ratio, 50% or more, signals financial stability. It indicates that the company is largely financed by shareholder equity rather than borrowed funds. Industries where asset ownership is critical, like real estate, often have higher equity ratios compared to sectors like finance, which may rely more on debt structures. Interest coverage ratio. A ratio above 3 is usually a good sign. It means the company earns at least 3 times what it needs to cover its interest payments. Lower ratios, especially below 1.5, can indicate trouble. Companies may struggle to pay their debt costs if earnings slip. Cash flow to debt ratio. A ratio of 0.5 or higher is typically healthy. This shows the business generates enough cash flow to pay off at least 50% of its debt annually. Firms with heavy operating expenses should aim for higher numbers to reduce the risks tied to fluctuating cash flow. Ultimately, healthy solvency ratios should align with industry standards. A tech startup's ideal ratios will look very different from a construction company's. Always compare a company's metrics to its peers for real context. Red flags in solvency ratios. When solvency ratios fall outside of acceptable ranges, they can indicate deeper financial issues. Here's what to keep an eye on. High debt-to-equity ratio. If the ratio climbs above 2, the company could be overly leveraged. This creates a risky situation, where even minor downturns in revenue might lead to a debt spiral. High ratios are particularly concerning for industries that don't rely on large capital investments, as it may suggest weak internal funding. Low interest coverage ratio. A ratio below 1 is a glaring red flag. It means the company's earnings aren't sufficient to cover interest payments. This suggests immediate financial stress and raises questions about the company's future survival. Rapidly changing ratios. Sudden shifts in solvency ratios often signal instability. For instance, if a business's debt-to-equity ratio jumps significantly within a year, it could mean the company has taken on too much new debt without the equity to back it. Declining cash flow to debt ratio. A shrinking cash flow to debt ratio hints that the company is generating less cash to handle its obligations. If this trend continues, the business may struggle to stay afloat as obligations build over time. Debt ratio above 70%. When over 70% of a company's assets are funded by debt, lenders and creditors may see this as too risky. It suggests the company has less flexibility to respond to financial challenges. When you spot these warning signs in solvency ratios, it's like catching cracks in a dam. They might not seem urgent right away, but left unaddressed, they could lead to serious financial issues. Always dig deeper into what might be causing unusual numbers, such as poor management decisions, declining revenue, or unexpected expenses. By regularly analyzing solvency ratios, you can identify problems before they escalate. It's not just about measuring the numbers, it's about understanding the story they tell about a company's financial health. Limitations of solvency ratios. Solvency ratios are powerful financial indicators, but they're not without flaws. While they provide valuable insights into a company's ability to manage long-term debts, their usefulness can be limited by factors like context and changing circumstances. Below, we'll explore some of the key limitations so you can avoid over-relying on these metrics. Contextual factors affecting solvency ratios. Solvency ratios don't operate in a vacuum. They're heavily influenced by industry standards and economic conditions, making interpretation tricky without proper context. A solid ratio in one sector could be a warning sign in another. Industry differences matter. Businesses in capital-intensive industries, like manufacturing or utilities, often carry more debt. Higher debt ratios are common here and not necessarily a sign of financial trouble. Meanwhile, companies in tech or services often aim for lower debt levels due to their lighter asset needs. Economic cycles play a role. During economic downturns, even well-managed companies can show weaker solvency ratios. Lower revenue and tighter cash flow might inflate debt to equity or reduce interest coverage. In contrast, booming economies often mask potential risks, as high growth can temporarily improve these figures. For example, a construction firm with a debt ratio of 70% may be completely normal, as it often relies on financing for large physical projects. But in a software startup, the same ratio might raise red flags about poor cash management or over-leverage. Without understanding the bigger picture, solvency ratios can lead to inaccurate conclusions. Always consider the company's business model, industry baseline, and the overall economy before making judgments. Historical comparison and trends. Analyzing solvency ratios at a single point in time can be misleading. Numbers fluctuate, and isolated data lacks context. You need to look at trends over time to understand a company's true financial trajectory. Why trends are important. A rising debt-to-equity ratio might signal growing financial risk, but it could also reflect strategic expansion. On the other hand, a sudden drop could mean the company paid off debt or is cutting back on investments. Without seeing the bigger trend, it's hard to know what's really happening. Avoiding snapshot analysis. Think of a single solvency ratio like a single frame in a movie. It tells you something, but you need more frames, the full timeline, to see the story unfold. Consider the interest coverage ratio. A company might report a strong ratio today, but if that figure has been declining for the past 3 years, it could signal trouble. Maybe earnings are shrinking, or debt costs are climbing. Observing year-over-year trends provides the clarity you need to identify patterns and potential red flags. To make informed judgments, always compare ratios across several time periods and in relation to industry peers. A healthy solvency ratio is great, but it's even better when it's stable or improving over time. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.